Good morning, everyone, and welcome to the Campus Research Call via Zoom webinar. My name is John D'Antona, and I'm the Director of Marketing at Capitus, Capital Institutional Services. Today's call and our topic is going to be looking beyond Election Day. We have two distinguished people on this call with me. First is our international trader from Campus, Forrest Hopper, and of course, we have Nicholas Collis from DataTrek Research. First, we're going to start off with Forrest giving us an update on the markets. Forrest?
Hello, good morning. Forrest Hopper here. Just going through a couple of high-level trends that we've seen recently. Not too much new with near-term market catalysts. You got the four that are kind of still on the board. You got short-term, long-term effects of COVID on the global economy, as well as certain industries that it's going to positively and negatively affect. The U.S. elections, of course, next week. COVID stimulus, which is still getting kicked around, and Brexit, which doesn't seem to go away. Looking at Capitus flows, month to date is pretty interesting versus year to date. Equity flows for Q1 saw a net selling of 5.42%. Q2 saw a net selling of 0.54%. Q3 saw a net selling of 2.55%. In October month to date, we've seen net selling of 8.03%. On the fixed income side, flows for Q1 saw a net selling of 1.82%. Q2 saw a net selling of 6.25%. Q3 saw a net selling of 1.38%. And October month to date has seen net buying of 42%. Equity market volumes are continuing to trend lower from the spikes in March and June, but they're still elevated 25 to 30% versus the last couple of years' averages. Technically, if we look at U.S. equities, looking at the S&P 500, we've seen a lower high here in October versus September. Also, price is now below a decelerating 50-day moving average, and is still 8% above the rising 200-day moving average. If you look at the rise in the market in the NASDAQ, in the Index NASDAQ 100 since March, top 10 names have taken up 65% of the index's gains. Apple, of course, being number one. They've been about 17% of those gains in the Index and about 10% in the SPX. Since July 31st, Apple has been 26% of the NASDAQ's move and 17% of the S&P move. A trader on our desk recently noticed that several of their clients were rotating out of large cap tech and into financials and industrials. Last week's investor intelligence sentiment survey showed bulls of 59.2%, bears 20.4%, and a correction of 20.4% as well, with the bull bear spread 38.8%. Overbought conditions generally are, bulls above 60%, the bull bear spread above 40%, which we're pretty much at. The VIX has been range bound since coming off the September pop, averaging about 27.29 closing since September 9th, and staying in a range of 24 to 32. VIX futures are still in a backwardation as we approach the election next week, although it's a lot flatter than it was over the last couple of months. U.S. Treasury curve has seen a bear steepen over the last couple of weeks. As the long end has risen 12 basis points versus the short end. U.S. 10-year yields up 30 basis points from the August lows, and have had some higher highs and higher lows during that time frame, as well as they recently ticked above the 200-day moving average last week. Non-10b5-1 insider selling has waned since the August peak. Year-to-date selling has been 10 to 1 selling, with a net selling of $14.7 billion. A couple of other interesting notes of trends we've seen. Chinese sovereign debt, foreign ownership was up 17% in 2019, is up 31% year to date, and on pace to be up 55% in 2020. That's on the heels of global bond index inclusion, their 10-year yield at 3.19%, and yuan appreciation over the last half of this year. Other notes are, you've probably seen all of the commentary on Robinhood. The CEO recently told Bloomberg that they might be reassessing the public access to the data that they had shut off in early August, which DataTrek had made famous by visualizing. And then the other thing of note is SPACs. special purpose acquisition corporations, the ability for somebody to raise what they call a blank check company. This has been going on for years, but has gotten more popular in recent times, specifically with a lot of name brand people joining the ranks of some SPACs. I think there's a space for SPACs. I like SPACs in general and the idea. Some of this has come on, financial services fees compression, as well as low interest rates on risk-free assets. But I would just encourage, due diligence as, the entrance in that space increase and potential for issues approach. Anyway, that's it. Back to you, John.
Thank you, Forrest. There's enough data in there that I think you could work for Nick's firm. Anyway, I'd like to turn it now to the focus, the main topic, and it's my pleasure to introduce a colleague and friend, Mr. Nicholas Collis, co-founder of DataTrek Research. Nick, go ahead.
Yeah, thank you, John. Let me get the video over to myself. There we go. So great. Thanks all for taking the time to listen in. The purpose of this part of the call is to give you our thoughts at DataTrek about how to frame an investment outlook for 2020 and 2021. And we called it Looking Beyond because we're trying to give you a sense of what's going to happen after the election, what's going to happen after the markets shift their focus from politics back to economics and back to earnings. So let me start the discussion by framing a few topics. And the first one I want to talk about is a little bit of myth busting. There's a very common piece of wisdom out there that says that markets like divided governments. They like when one party holds the White House, the other party controls Congress, or at least one of the chambers of Congress. And we took a look at that, and the actual history is somewhat different from the myth, if you will. And the myth, I think, started in the 1980s with Reagan and Tip O'Neill doing a lot to help the U.S. economy come out of the early 80s recession. But if you go back to 1945 and look at all the 2-year periods of time when Democrats have controlled both the White House and Congress, you'll find that the S&P is up 14.6%. When Republicans control both chambers of Congress and the White House, the S&P on average is up 16% a year. So 14.5% for Democrats, 16% a year for Republicans. And no surprise, both of those are better than the average from 1945 to present return for the S&P, which is 10.8%. So it isn't true that markets like divided government. Markets actually do okay with one party or the other controlling the entire outcome. And I think that's important because as we think about potential outcomes coming out of this election, there's a lot of concern about what happens if, say, the Democrats sweep both chambers of Congress and the White House. And the historical precedent says it could be okay. It's not going to be on average as strong as, say, when Republicans hold, but the averages back to World War II say the market can do just fine. And I think the reason is that it's basically because one party controls the outcome and controls, therefore, what's going to happen with fiscal policy and different regulations and so forth. And then when one party owns it, the market seems to say, okay, you own it, and they tend to do okay with it. The example I would tell you is election night 2016, when we had the huge reversal in futures overnight. And I think a big part of that reason wasn't just that President Trump won the election, but that you also saw the Republicans control both houses of Congress, and the market realized, okay, one party owns the economy, and the market reversed and headed higher, and there was a pretty strong rally going into Inauguration Day the following year. Now, could it be different this time? Obviously, things can always be different. There's a lot of concern about future tax policy, both corporate and individual tax policy, out of a potential Biden administration and Democrat-controlled House and Senate. Fair enough. But I would also say that there's a countervailing factor of potentially much greater stimulus and a large infrastructure package if you do get Democrats holding both the legislature and the White House. So I think it's a push and pull, but I wouldn't immediately write off an all Democratic sweep as something bad for the markets for the next couple of years. History says it's just clearly not the case. Now, let's move on to some historical comparisons to help us think about the next couple of weeks. There's a lot of focus on 2000 as the right historical comparison, and there's some intuitive appeal to that because that was the last time we had a contested election. And there's still some modest concern that we get that kind of result. And I'll tell you that 2000 isn't a great comp for this because if you think back to what was happening in 2000, the dot-com bubble was bursting, the economy was slowing, the Fed had been raising rates, and the period from election day through to the end of December was just a hot mess of headlines about Apple missing earnings, Bank of America missing earnings, the economy slowing down dramatically. The Fed actually had to come out right in the middle of that sequence and say, okay, maybe we're done raising rates, maybe rates have to come down. So the 2000 experience isn't really a great comp, and I would kind of throw it out the window. I've seen a lot of people kind of make this mistake that thinking 2000, when the market had a lot of volatility, was all due to the contested election outcome in 2000. It wasn't. It was dot-com blowing up. It was the economy slowing down. It was a whole slew of earnings misses. And we went through and looked at like the daily headlines, and it was very clear like the market was somewhat worried about the election outcome, but much more worried about dot-com bubble, bank earnings, and so forth. Now, that's the good news. The bad news is we think 2008 is actually the more important comp, because if you think back to 2008 Q4, we had an election. It was McCain versus Obama, and President Obama won, obviously. The problem was that there was an interregnum in DC between election day and inauguration day. And in the meantime, the economy was under tremendous stress because of the financial crisis. And if you go back and look at those headlines, and I'm sure those of us who are there will never forget them, you had tremendous volatility around just passing a TARP package to save the financial system. There was not even any talk about fiscal stimulus until February of 2009 when the ARRA passed. That was the signature stimulus bill that came out right after Inauguration Day in January. The market didn't bottom until March of 2009, and that was the famous S&P bottom at 676 in March. And that's really the lesson that we're worried about is what if you get whatever political outcome you get from next week, what if it slows down a stimulus package until next year? You know, we're not going to get a stimulus before Election Day. That much is clear. We need one for a variety of reasons that we'll discuss in a minute shortly thereafter. But at the same time, the political situation is somewhat fraught. So the thing is here is we're not worried about 2000. That's not the right comp. 08 is the right comp, and that's a bit of a problem because 08 was not exactly a signature event where DC stepped up at the right time and did the right thing. It waited on a political outcome, and that political outcome forced even further waiting going into the beginning of the following year at a time just like now with the U.S. economy under significant stress. Now, let's move on to some outlook points. Let's just start with the near-term outlook. 2 words, very choppy. If I had to pick 3 words, be very, very choppy. You know, Q3 is going to be a good GDP quarter, up 35 to 40%, no doubt about it. Big snapback in the economy. The Atlanta Fed GDP Now model, which is what we use and think about in terms of looking at real-time updates on the economy, have been trending very strongly. Q3 was fine, good recovery. But Q4, not so good. The Q4 GDP nowcast from the New York Fed, this is an algorithmic model that looks at a lot of different inputs and comes up with a guess as to Q4 GDP, is only up 3.5% right now. And then those estimates have been declining over the course of the past month. So the trend line is not particularly good. So as strong as Q3 is going to be, Q4 is going to be quite weak. Now let's talk about unemployment. We've obviously had a very rapid recovery from April. April was 15% unemployment, 8% last month, nice gain. But we look at this through a state level lens. We look at the state level unemployment data every month. And the reason unemployment came down so quickly was really because of all the reopenings in the southern states, Texas, Florida, Georgia, the Carolinas. Those unemployment rates came down very quickly. And that's why it allowed the US number to come down very quickly. Unemployment in the Northeast and in California, still extremely high. Even now, pushing up over 9% in many places. Unemployment in New York City is so high that you've got still 15%, 14% unemployment in New York City. And that's a big chunk of people in the entire country. You know, we're very overrepresented here in New York City, where I'm talking to you from in terms of unemployment. we're not going to improve very quickly here in New York. We're not going to improve very quickly in the Northeast. And unfortunately, after those early reopenings, now with concerns about the virus growing again, you're getting rising unemployment in a lot of the southern states and Texas. And that was sort of the unusual thing that happened in September's unemployment data, as you saw them come down from April and then begin to pick up again. And so as a country, we seem to be kind of leveling out right here at 7 to 8% unemployment. And I think that's going to be the case for a couple of more months at least, because as much as we made good progress, we've now got to take a step back. And that's going to be what happens in the fourth quarter. I would also highlight this is kind of the perils of the service economy. If you think about the US economy and labor force, 20% of all workers work in leisure, hospitality, and retail. And it's been that 20% for the last 20 years. But what's happened is, as retail lost market share to online, those employees left the retail system and went into leisure and hospitality. That ended up with a very, very heavy amount of service and leisure and hospitality workers going into 2020. There was, when we were looking at this data 10 years ago, it began to be obvious that leisure and hospitality was going to be the primary growth engine of the US economy and labor force for the next 10 years. And that's the way it turned out. But it left us in a pretty uniquely vulnerable position in terms of the pandemic to getting unemployment back, because leisure and hospitality is still quite weak. Moving on to, say, spending, consumer spending. The New York Fed had a very good study recently that showed that the majority of those stimulus checks that went out early this year were saved initially or used to pay down debt. It's clear from the retail sales number that we've seen recently, the consumer spending is beginning to pick up. Those stimulus checks are getting spent. However, only among those who feel okay about their employment picture. The rest of folks will still continue to save that money and use it for rent, use it for necessities. And that's a big reason why we need another stimulus round, both in terms of incremental unemployment insurance payments and one-time fiscal stimulus, because as much as the economy has recovered, it really is back to being at a tipping point, both in terms of employment and GDP growth, as I've highlighted. GDP growth slowing down, unemployment no longer improving as quickly as it was, and the prospects aren't great for any kind of quick further improvement as well, because of all the containment measures that we have to do to contain and control the virus. That leads me to holiday 2020, which is really like the next big catalyst in terms of economic activity. On the plus side, people are staying closer to home. We just did some recent work on travel, and travel is still nowhere near where it was. It's still down 65 to 70% versus pre-pandemic levels. And going into holiday, we look at airplane ticket prices, and we find that, unlike the usual Christmas or holiday where Thanksgiving week or Christmas week is 3 or 4x the usual rate, this time around, same price to fly from New York to Bermuda, New York to California, New York to Florida, the week of these holidays as the week before or the week after. So it tells you there's still not a lot of demand. And the bottom line here is all these economic trends that we're talking about, the uncertainty over growth, the uncertainty over unemployment, the uncertainty over spending will continue into 2021. It's going to be a very choppy year. We do some work for a consultancy firm, a large one here out of New York, and we did a call for their clients on the budgeting and CFO and treasurer side. And my message to them at that point, my message to you now is, don't be surprised to see 2021 have a couple of growth scares where the economy looks like it's tipping back over into recession. That's going to be the nature of this recovery unless we get a lot of fiscal stimulus and an infrastructure package. That's just the way it's going to feel. Now, let's move on to corporate earnings. Just by way of background, I spent 10 years covering the autos at the old First Boston. So I come at earnings from a very fundamental standpoint. I've done my share of earnings models over the years, listened to more than my fair share of earnings calls. And so we look at this at a very fundamental grassroots earnings model kind of approach. And just to give you a sense of how I think about it, the bottom line on U.S. corporate earnings is they never got really bad this year. The trough was $28 a share for the S&P in Q2. This year is going to be $35 a share, or this quarter is going to be $35 a share. So it's not like the financial crisis where we got the zero S&P earnings. Like the S&P earned no money in Q4 2008, and the recovery was pretty swift off those levels. We didn't get that bad this time around. It's why the market didn't really fall apart. back in March. 2237 low felt horrible in March, but it wasn't the kind of drawdown that we saw that grounded lower and lower and lower that we got in 2008 because stimulus came in and because earnings baselined at a non-zero level. They were still way off the $40 a share we were running before, but 28 a share for the second quarter, not a bad result. What we have to do is now think about what's going to happen in future quarters. And the way analysts have these numbers right now basically assumes that we're going to get to roughly $45 a share in Q4 of next year. That's that earnings run rate. So we had a good Q1, a lousy Q2, and by the end of 6 quarters from now, we're going to be 60% higher than we were at the trough. Now, that 60% improvement in some ways is very logical. Corporate earnings always rebound before economic conditions rebound. Corporate earnings pick up a year on average before unemployment peaks in the US. And there's a good reason for that. Corporations do what it takes to sustain profitability in a downturn. And because they don't know how deep it goes, they always cut more than they end up having to. As earnings recover, they use those cash flows to stabilize their balance sheets and then begin to rehire. This is the cycle as it occurs. Every cycle back to World War II looks exactly the same way. So corporate earnings are going to be fine. That is the way it works. And people talk about a K-shaped recovery with shareholders doing better than workers. Absolutely true. Also true that it's always that case. It is always the way it works. That is how it's worked since the beginning of economics. And that's the way it'll work in the next recession as well. It's a feature of the system. That's just the way it happens. Now, let's talk about how realistic 60% improvements are in earnings between the trough in Q2 and 6 quarters out. On average, the typical recovery, and we go back to the 1990s and 2000s, the typical earnings recovery is more like 40%. And we think about this a lot. Actually, I just wrote a long piece on this last night for clients. And the question is, how realistic is to think that this recovery is going to be 50% better than average in terms of corporate earnings? And you can definitely see both sides of the coin. You've got some very good stimulus early on. You've had a whole raft of cost cutting, and that in terms of labor, in terms of CapEx, is helping marginal profitability tremendously. And we're seeing that in the earnings numbers this quarter. They're coming in well ahead of plan, well ahead of expectations, because contribution margins are extremely high. Like I was just looking at Cat Tractor's earnings this morning. Incremental cash flow from Q2, I think up $400 million. Incremental margins up strongly from Q2. So even a very high fixed cost business, very reliant on CapEx, is showing real improvement versus Q2. And that's great. That's the way it should be. That's the plus side. This is the way it always works. The downside is looking at what is the typical industry or sector level recovery in earnings. Every recovery looks pretty much the same. It begins with recovery in financials earnings, usually accompanied by a recovery in energy earnings. And then you get industrials kicking in a little bit. And those are the kind of cyclical sectors that create that 40% bounce. Here's the problem. Financials aren't really in a position to generate that kind of huge upside to earnings in 2021 unless loan loss reserves come down dramatically and quickly because the economy improves dramatically and quickly. That seems unlikely. Energy is in its own mess right now because commodity prices remain so depressed and because demand has not come back. If you look at gasoline usage in the US, you'll see that we're still 10% below the normal run rate of Q4 of last year. Again, a problem. So as much as I, as a cyclical analyst, believe the 60% up over 6 quarters is achievable, it's a little bit hard to map how exactly you get from point A to point B. And that's, I think, why the market is so focused on getting further fiscal stimulus, because in order to hit the kind of numbers the street has, and maybe the street's high by 10 points and the market's okay with that, the market would not be okay with the street being 20 points high, missing, thinking 60 and getting 40. It's hard to justify a 2021 PE market if you're not going to get the kind of 50, 60, abnormally high cyclical bounce in earnings that the street's expecting. Those two things are pretty much in sync, but we're not going to get there, I think, without some further fiscal stimulus. Fiscal stimulus in terms of one-time checks to spur consumer spending and incremental unemployment benefits to help out folks, particularly in the leisure and service economy, that are so affected by the virus and not being able to work. So Let me spend the last 5 minutes of our conversation here and just discussing a couple of things that we like that we're telling clients they should overweight or have exposure to. Now, first, in terms of US versus international stocks, we think there's a lot more earnings leverage in US stocks versus international stocks, particularly EFA, Europe, and Japan stocks. Those non-US developed markets are problematic in a number of perspectives. First, because they handled unemployment differently during the crisis, they're not going to get the same kind of earnings leverage on the way out. Secondly, there's basically no tech exposure in Europe and Japan. SAP was the tech giant in the EFA index until yesterday. And when they missed on earnings and discussed their outlook, the stock was down 20%. That is a problem. You cannot invest in the 21st century in an index that has less than 10% tech exposure, which is what the EFA index has. So as much as we like some cyclical aspects of EFA, the overall market, the overall index, we think is very problematic. Now, turning over to emerging markets, we tend to like those a little bit more. Those tend to be more cyclical, more exposed to the US economy recovering. And as we've seen with China in particular, China is now plus 40% of the emerging markets index. And there's a lot of good tech exposure there. Tencent, Alibaba, the New Ant Financial, all those things we are pretty excited about. They're important disruptive companies with a good growth trajectory ahead of them. But above all else, we like US over both EM and EFA for the moment. We would favor the cyclical sides of EFA and EM over US, but if you had to pick one region, US is the one we're going with. Now, in terms of US stocks, we like small caps over large caps right now for two reasons. The first, I hate to sound like a broken record, but the earnings leverage in small caps is profound. Small caps always outperform coming out of a cycle as long as high yield spreads continue to decline. And they have. Small caps, a lot of unprofitable companies. They need the high yield market in order to have access to capital and reasonably priced capital. High yield spreads are coming down now, and small caps should continue to outperform. We like small caps. The issue we have with large caps is just as much that it's such a tech heavy index at the S&P level that we worry a lot about what we call the tech's tough comp problem. Tech has had a monster 2020. Apple, Microsoft, Amazon, not so much Facebook and Google, but those three names have had tremendous operating leverage, tremendous results. And we'll see Microsoft tonight and Apple on Thursday and see their numbers, but we're pretty convinced they're going to be awesome. And that's the way they should be. However, it sets up a very tough comp problem for 2021. How, as a tech company, do you beat a record, global refresh cycle in hardware? How do you beat the system that we're on now, Zoom? How do they generate incremental growth and keep investors excited? So we're a little bit worried about tech here. A couple other macro points. We think the dollar is going to weaken. It always does in a recovery, every cycle, going back to the 1980s. When the global economy recovers, the dollar weakens. And it's not because the US is, behind the curve or not handling the virus well or anything else like that. It's purely because money, capital leaves the US and goes to riskier asset bases when economies recover. And we do expect a recovery next year, however choppy. And so the dollar should continue to weaken. And that's fine. We're favoring more shorter term maturity debt because we do think the 10 and 20 and 30-year part of the Treasury curve continue to climb in yield, although relatively slowly. And then finally, we like high yield bonds over investment grade bonds because we see further room for improvement in the high yield market in terms of spreads coming in over the investment grade market, which, while it's backstopped by the Fed, essentially doesn't really provide a lot more upside in terms of spread compression versus high yield. So let me sum up what wanted to get across to you today. The first is we're pretty optimistic about a 2021 recovery, both in terms of global economy and U.S. economy and U.S. corporate earnings. Of the three, I'll tell you that we're most confident in U.S. corporate earnings continue to recover. U.S. companies do what it takes to generate incremental profits. So we're fine with stocks here, even at current valuations, and see another at least 10% upside over the next 12 months. We do like small caps over large caps just to get that incremental, upside leverage. And on the downside, we do think it's going to be, at a headline level, a kind of a tough slog for the next couple of quarters. Not just because the election creates uncertainty. We're actually okay with that. And if the Democrats take over everything, the market says it should be okay as well. But at the same time, we recognize that it's, point A is fine, point B is fine, the point B we're describing, but the path between the two can be a little bit choppy. So with that, I think we're at the end of our time. I'll hand it back to Kappas for any closing remarks.
Sure. Thank you very much, Nick. I had put out on the chat if anyone had any questions to please send them. And I just got one right now, so I'll read it to you, Nick. I'm not sure if you can see it. Any thoughts about the effectiveness of PMCCF/SMCCF? Was it more about the signaling that the Fed would be the lender of last resort to calm the markets? Or do you think they'll start to accelerate more purchasing?
Yeah, that's a great question. Okay, so just a little bit of background for the alphabet soup part of that. These are the programs the Fed put in place to buy corporate bonds, primary and secondary credit facilities. The reason they did it, or the reason I'm convinced that they did it, is because the investment grade spreads back in March got to exactly the level of where the Fed marked the stress test. So the banks, all the US banks have to go through a stress test every year. And every year the Fed puts out a scenario that says, okay, plan for this and tell us how you would do. One of those is investment grade bond spreads. And I believe the stress test level is 488 basis points. So if investment grade spreads get to 48 over treasuries, that's what the banks budget for in terms of a stress test. So it's kind of in the back of the Fed's mind as a problematic level for investment grade bonds. Investment grade spreads went from, I think, 130 over to 410 over between January and March of this year. And I think that's when the Fed stepped in and said, whoa, not everything is hitting our stress test levels, but that market really is. And that's a problem. And it's not just a problem for typical US companies. It's a problem because 25% of the investment grade market is banks. It's financial services. Bank of America is the single biggest issuer in the investment grade market. This is how banks fund themselves. And so the primary credit facility and secondary credit facility were really a response to this tremendous quick dislocation in the investment grade market. A little bit of it was, worrying about whether or not a marginal credit like Ford, for example, that was the one that most commonly called out, was going to see a big downgrade and, be in real trouble. So the Fed had to backstop some piece of the high yield market. But the good news is over the course of the past 6 weeks, and you can see this on the Fed's data, they haven't had to buy a lot of incremental bonds. So they've been kind of out of this market for the last 6 to 8 weeks. And so that tells us that they like what they see. Spreads are coming in on their own, and there's much less stress in that market than there used to be. If you did see another raft of bad economic news and investment grade and high yield spreads began to blow out again, no doubt the Fed would step back in. But I think the balance sheet levels right now are like $46 billion at the Fed, so not a big part of the Fed's balance sheet. It's more of a psychological backstop than it is a real financial backstop at this point. But no doubt it was helpful in calming things down in March and April.
Okay, the person says thank you for that answer. Another question I just got is, what might cause you to rethink or change your 2021 outlook?
Yeah, I probably spend an hour of my day thinking about that. It's a couple of different things. The first and most obvious would be the course of the virus through the winter. I live in New York. I'm talking to you from New York City. I stayed in New York through the entire March, April timeframe and have been here ever since. Haven't left even for a night. And I'll tell you that, I am worried about a second wave, and I am really surprised as to how badly Europe is handling their second wave so far. And we do a lot of work monitoring European traffic and economic data, real-time data. And it was clear to us even a month ago that Europe had gone back to normal too quickly. And we're now seeing the result of that. We saw that in the traffic data from Berlin, from Milan, from Paris, from London, everywhere. And I can tell you, sitting in New York, traffic is nowhere near back to normal. People are not out and about. And we've been pretty much okay so far. But if we did get a big virus second wave that caused a lot more shutdowns, that really disrupted the economy again around holiday season, for example, that would be a problem. I'm cautiously confident the US can do a better job than Europe right now. The other thing would be, a very fractured political environment. And I think about that a lot as well, because there are some scenarios where politics becomes kind of boring again in this country. And there are some scenarios when it doesn't. And we kind of have to think about all of them. And if it weren't for, the virus, we wouldn't have to worry about it so much, but we do need government support in terms of further fiscal stimulus. And we've seen how fractious a topic that can be in the current environment. If we have a split Congress and White House next year, do we get another big fiscal stimulus package? Hard to say. So those are the two things that I worry about: the trajectory of the virus in this country and whether or not it really slows down holiday and going into Q1 of next year. At the end of the day, I do think we get a vaccine by Q2 and Q3 next year. That's what scientists seem to be telling us is reasonable. So we're talking about transitory issues, but we had a big shock in March and April. We've been recovering slowly. What we want to see is, at the worst case, stability, and the best case, continual gradual improvement. That's our base case, but I totally get where it could be wrong.
Okay, Nick, thank you very much. I have no further questions. I just want to again thank everyone, Forrest and Nicholas, for coming to this webinar, and for our attendees for giving us 30 odd minutes of your time. We really appreciate that. And we invite everyone here to, of course, follow Capis on either LinkedIn or on our Twitter feed, or reach out to our trading and sales desk. We're here to help. And thank you very much, everyone, for joining. Again, Forrest, Nick, thank you.
Thank you.
Have a great day, everyone.